that I believe speculative investors need to own the number of speculations in their portfolio that correspond with the number of hours per month that they spend studying those particular speculations. If you're willing to spend 10 hours a month, you can hold 10 speculations in your account. It's important that you meet with management. It's important that you read the management information circulars and the filing statements. It's important in natural resources that you understand enough of the geology that you can understand whether the presentation that is given to you is factual or farcical. So let's begin with today's overviews. We have 5 factors that the reporters among you might know in terms of understanding a story: who, when, where, what, and why. We're going to discuss each of these factors, not, as I say, as the be-all and end-all in terms of due diligence around speculation, but rather as a sort of a survey of what you have to know about a company, about knowledge that you need to continue to understand, to update yourself to be successful in speculations. As for myself, I always go into a speculation, if I write a check, with a plan, which is to say, I write down why I have invested in this company. I write down what I hope to accomplish. I write down what can go wrong. I write down what can go right. And I write down the approximate time frame that will be required for me to understand whether I have been successful or unsuccessful. It's important to note that when a company varies substantially from plan, which is to say, when the reasons that you own a company go away, the stock should go away too, irrespective almost of the price at the time it has to go away. Too many investors who buy a speculation at $1 see it at 70 cents, see that the reasons that they owned the stock went away, but they refuse to sell it at 70 cents, hoping against all hope that it'll go back to $1. This almost guarantees failure. So let's go into it. The first thing I would say is that in my experience with speculations, the who, which is to say the people, are almost always more important than any other consideration, particularly with regards to natural resources, which are regarded commonly as an asset-intensive business. In fact, they're knowledge-intensive businesses. Exploration is actually an intellectual capital business, much like, say, biotechnology or the algorithms around software. So knowing about the people who employ the intellectual capital is actually the most important part of mineral exploration and oil and gas exploration businesses. So we're going to talk first of all about knowing who. Understand the past successes of the management and directors, especially as they are related to the task at hand. If the CEO tells you that he, in this case, has been successful in mining because he operated a gold mine in Archean, 2 billion-year-old rock in French-speaking Quebec, but the task at hand is exploring rather than operating for copper gold in 15-million-old tertiary volcanics in Spanish-speaking Peru, although the person has been a success, the success that he has enjoyed is not necessarily success that is relevant to the task at hand. So past successes in almost every circumstance should be related to the task at hand. It's important, too, to know the skill sets beyond the CEO. Why, for example, was the chairman of the board made chairman of the board? What role will he or she play in the success of the company, and how does their resume talk to the task at hand for them? Has the chief financial officer had experience in capital markets? Can he or she raise money? In an exploration venture, is the VP exploration, which is to say the geologist, experienced in the rock package that they are operating today? If in oil and gas, in the same basin, in the same horizon. Very important that you back successful people and you back people who are successful at the task at hand. Another thing is that these people who run the company must be partners of yours, not employees of yours, which is to say they need to be very, very, very large shareholders. The probability that somebody will work very hard for 5 years to make a lot of money, if they themselves are not going to make a lot of money, is a very low probability. The probability, too, that they will become too aggressive with the cash on hand if that cash is not theirs, which is to say, if they aren't punished for malcreants means that they will be unnecessarily generous with your money if their money isn't in place. Very, very important. Finally, who are their backers? Who are the money? Who is the capital behind the company? If they need money, when they need money, where will they get it? Who will handle the promotion? How will the promotion be handled? What experience do the backers have in propelling companies like this from ideas to success? I want to leave you in terms of the know who discussion with one simple observation. I've been involved in natural resource capital markets now in excess of 45 years. And the truth is that I have made almost all of the money that I have made in the sector behind 10 or 12 management teams. If I had simply, over the course of the last 4.5 decades, focused on the few people who had been serially successful and who stuck to their knitting, I would have worked half as hard and I would have made twice as much money. Remember this. Other things can get you excited, but the thing that you need to know in speculation is the who. Who are the backers? Who are the shareholders? Who are the managers? Why were they chosen? How were they chosen? Were they chosen wisely? And are their past successes germane to the task at hand? Having done who, just for fun, let's do know when. Know when to make a speculation. Believe me in this, bear markets are best. The best time to speculate, the best time to invest, the best time to engage in private placements is when you are very lonely in the activity. Think about this. If money is made in equities by buying low and selling high, how on earth are you going to buy low in a bull market when you have lots of competitors? You buy low in a bear market and you sell high in bull markets. So in terms of knowing when, remember that bear markets are best. Away from a bear market, look for circumstances to buy where other people are selling. One classic example of that is in a stock that has been declining in share price around the quarter's end, where the mutual funds and the large money managers, the segregated accounts managers, sell out stocks that are down in the quarter, so it won't show up in the quarterly inventory of their holdings, and they won't have to explain away the quarterly decline in those stocks. A stock that has declined 5 or 6 or 10% for the quarter will often be sold off at quarter end simply so that the portfolio manager doesn't have to acknowledge having owned that stock and taken that loss in the prior quarter. In terms of resource stocks, particularly Canadian resource stocks, there's a phenomenon called the summer doldrums, which is to say July and August. I don't know why. Perhaps the rich people in Canada are away at their summer cottages. Volumes dry up and the stocks sell off. To the extent that the stocks seemed expensive in Canada, as an example, post PDAC, when everybody was excited about things, they very often sell off in the summer doldrums. 2, tax loss selling in the third and fourth quarters of the year. When people look at losing positions and they think about selling those losing positions to crystallize tax losses, very, very often you will be available to pick up bargains because people are selling for reasons that are unrelated to the fundamentals of the company. So knowing when to buy is an important part of knowing how to buy. Remember that bear markets are better for you. As an example, let's look at 2 different things. Let's look at the uranium market in 2018. Nobody, literally nobody cared. The price of uranium had to go up. Anybody who thought about it knew that it hadn't gone up. But because it hadn't gone up, there was no urgency to do it. Fast forward to last year, the price had gone up. And after the price had gone up, which is to say, after the juniors had appreciated by 400%, that very appreciation, the fact that they had become much more expensive, made people eager to own them. Simple question to ask yourself: is it better to buy cheaply when stuff is out of favor? Or is it better to buy when it's easier on you psychologically after it's already run by 400%, when the logical person turns into a seller rather than a buyer? So knowing when, while less important than knowing who, is an important part of speculative trading. Knowing where, this is something that's going to take a lot of heat from this audience, I suspect. I suspect I'm going to get a lot of social media hate around it, which means I'm saying the right thing in almost all circumstances. Knowing where involves, as an example, an understanding of political risk. When you look at me on this screen, you see the vision that most people think of in terms of sociological stability, which is to say an old, bald, fat, white male. People tend to have an odd sense of political risk. People tend not to be afraid of political systems that they inhabit. And in particular, there's a racial element around political success. For some reason, people believe, at least white people believe, that risk is less in Caucasian countries when the money is stolen from you by the legislature in English according to the rule of law. I need to tell you that my worst experiences with political risk have come from the governments that have been closest to me. My worst realized political risk, in fact, happened in the People's Republic of California. My second worst example of political risk very recently was as a homeowner in Vancouver, British Columbia, but being a non-resident owner, the criminal city council and the criminal provincial legislature decided to tax me 7% of the appraised value of my house every year. During COVID, when I couldn't occupy the house, rather than giving me a break, they doubled the tax rate. Think through that. 7% tax on top of the normal outrageous taxes in British Columbia is in effect confiscation on the installment plan. And yet people tell me that British Columbia isn't a risky political jurisdiction. So it's very important that you consider the knowing where in the context of the reality rather than the perception. Is there political risk in Bolivia? Yes. Is there political risk in Zimbabwe? Yes. Is there political risk in Russia? Yes. What happens with this risk is that you often realize it and you often consider it. You don't realize and consider the risks that you face from legislatures in places like the United States, Canada, France, Australia, developed Western countries, where the risks are much greater than they would otherwise appear. Knowing where to in resources is important because some areas have richer endowments. If the company that you're investing in is preparing to look for oil and gas, as an example, the Middle East, where oil is, might be a very good place to look. The Texas Gulf Coast might be a very good place to look. Alberta might be a very good place to look. Prospectivity is important. Not just prospectivity with the probability of finding some reserves, but rather prospectivity aware where you can find tier 1 reserves, which is to say deposits, either mineral deposits or oil and gas, with a minimum in situ recoverable net present value of $2.5 billion, with all-in sustaining costs in the best quartile in the industry and returns on capital employed in the best decile in the industry. You aren't looking for the chance to get a little lucky, you're looking for the chance to get real lucky. And that involves geography, it involves prospectivity. So in terms of where, understand political risk for what it is. And understand, too, that if you're involved in natural resources, you want to confine yourself to geologies and geographies where you have the ability to make a relevant and meaningful discovery. That's where the money is made. So we've done who, we've done what, when, we've done where. Let's do what now. The most important what is this. 4 words. What can go wrong? It's important in considering an investment where you're focused, of course, as a positive person on what would happen if you got everything right. Think about what could go wrong. I will tell you this. In every single speculation that I make myself write down the 3 most probable flaws, the 3 things that I consider to be the greatest risk. My belief is that if you can't easily identify 3 things that could go wrong with any speculation that you're involved in, that you don't know enough to write the check. Repeat, If you're not very afraid of three things around an investment, you don't know enough about the circumstance to write a check. There is no speculation on this earth where there aren't at least three factors that could go wrong. You don't need to focus on those factors, but you need to understand those factors so that you can cut your losses when, as, and if one of those things becomes available. Repeat one more time. The most important is what could go wrong. The backside of that is what could go right. Let's look at the circumstances around an investment, how you made the investment, what your goals are for the investment, and how you could be shocked to the upside. I remember very well in the case of Arequipa Resources back in the early part of the 1980s. Wonderful prospect generator, superb geologist, David Lowell, looking primarily at large copper porphyries or large copper porphyry exploration targets in Peru. By the way, a place nobody wanted to be at that point in time. And he came upon a small, what we thought was perched gold deposit in the Andes. And he made a case for me that this could be at least 300 to 500,000 ounces. And if so, that 300 to 500,000 ounces would be worth the then existent market cap of Arequipa. But guess what? Something went right. Mr. Lowell didn't find 300,000 ounces. He didn't find 500,000 ounces. He found about 8 million ounces. So think too, while you're focused on what could go wrong, what could go right. Look at the data and look for circumstances where, as the data changes, that the upside that you've associated with the stock can change too. Had my targets on Arequipa been the same, when the stock went from $1 to $2, I would have sold. The consequence of something going right that I hadn't anticipated meant that a dollar stock, actually a 35-cent stock when I bought it, went all the way to $30. So while you need to consider what can go wrong, you need to consider the data as it comes into you in terms of what could go right. Is this company actually exceeding expectations? Which means that you can reset your expectations higher and be confident in capturing more of the gain. What too includes what is the deal? If this is a private placement, what are the deal terms? What is the pre-money valuation, which is to say, how much money are you paying for the opportunity? Do the private placement terms include a warrant? For those of you who don't know what warrants are, they are the right but not the obligation to invest another sum of money in the company at a fixed price at a later date, if the money that you had originally contributed to the company generated some success. It's a way to get paid twice for taking the same risk. So what are the terms of the private placement? And finally, why? This is what most people put first. Why are they doing it? What is the story? It's good to understand the entirety of the story from the management's perspective, if only to understand what they're trying to accomplish and what investors who listen too slavishly to them will believe to be the circumstance that is coming true. Understanding variances between the why and then the who, the when, the where, and the what will give you the ability to more properly assign validity to the why. My favorite why is value to price. If I believe that an asset, even a development stage asset, is worth, say, $50 million in liquidation, meaning I could sell it to a competitor for $50 million, and that asset is on sale on the market for $30 million, that's a pretty good reason why. If by contrast, I think the liquidation of the asset is $50 million and the market capitalization is $100 million, there better be some amazing upside. If, as a consequence of writing a check, I'm immediately offside by 50%, I need an awful lot of upside to compensate for that downside risk. It's interesting that most speculators in the world pay slavish attention to price, the share price. That's easy to obtain information, but it has no utility at all. The price information has no utility at all if you can't juxtapose it to the value. If you don't have some sense of what something is worth and what something is likely to be worth after it's been beneficiated by effort and time, the price is irrelevant. It's the gap between price and value, which is where you made money. Another why is relevance. Too often in the resource business, people speculate on small mines. The truth is that a small mine has all the risk attendant that a big mine has, but a small mine can only make you small money. Why would you take big risk for small money? Relevance, which is to say deposits with in situ value, recoverable value of more than 2.5 billion US dollars. That will be, you believe, in the best quartile worldwide in terms of all-in sustaining costs and the best quartile worldwide in terms of return on capital employed are where you need to be. Y2 includes funding requirements. Does the company have enough money to meet the objectives that they sold to you in the Y part of the presentation? If somebody says we're going to drill 100,000 meters and the consequence of drilling 100,000 meters is that we're going to prove up 1 million ounces of gold, how much will it cost them to drill 100,000 meters? How much time will be required? Do they have that much money? If they don't have that much money, where will they get the money? If the goal is to do it, but the means aren't available to achieve the goal, it's pretty obvious that the expectations won't be achieved either, and you will show a loss. So knowing the funding requirements and knowing the funding availability is important. This is by no means an exclusive list, but this is a list that is meant to get you started as a speculator, either as a trader or as a private placement investor. So let's go through them one more time. Knowing who is the most important. Having serially successful people who have been successful at the task at hand is the best determinant possible to making money in the markets. Know when. Bear markets are best. If you're a buyer, remember that you want a stock to go lower rather than higher. The idea that you want to buy something, but you want to pay up for it is the height of insanity. Know where. Understand the nature of political risk. Understand that money that's stolen from you by white people, according to the rule of law, is no less gone than money stolen from you by governments elsewhere. Know what, in particular, what can go wrong, and know why. The principal why is value to price and the ability to utilize cash on hand to increase the value of the asset around. I always enjoy talking to all of my friends from the Money Show, and I'd like to leave you before the questions and answer session with an offer. Any of you who care, who value my opinion with regards to natural resource stocks, will probably be most interested in my opinion as to the value of your existing portfolios. Any of you who go to my website, ruleinvestmentmedia.com, will be able to enter your natural resource stocks. I personally will rank them 1 to 10, 1 being best, 10 being worst. Any individual company where I think my comments might have value, I'll comment on the individual issue. In addition, you'll see a question and comments section on the same page. If any of you are interested in what private placements I am doing, mark down placements. There's no guarantee because I get into a placement that you'll get into a placement. But if you'd like notification as to what placements I'm going to do and why, enter placements in the comments section. Finally, I'm celebrating retirement. Many of you know I'm 69 years of age by backing a group starting a new bank. This is a group that I've backed before. They started EverBank, which went from a standing start to $28 billion. We sold EverBank. We're doing it again. If any of you are curious about banking, either from the point of view of being an investor, being a depositor, or being a borrower, particularly if you are a precious metals holder, in the question and comment section at ruleinvestmentmedia.com, please enter bank. Mr. Moderator, that's the end of my formal presentation, but I'd be delighted to answer questions in any time that I might have remaining.
We have a couple of minutes left and more than enough questions to fill that time. So without further ado, let's delve into the first one. What are your thoughts on owning oil service stocks as opposed to the oil companies themselves?
As a broad subject, I'm attracted to the oil service sector because I believe that capital investments in the oil and gas sector will stay strong for at least 5 years. I have been a less successful investor in oil service than I have in oil because I know more about oil and gas exploration than I do in oil service. But if you leave me out of the equation, I think that the sector is probably a very good place to be, particularly if you understand it, of course.
Thank you so much for that. Next question we have is, where does the macro situation fit into your speculative strategies and analysis of companies? For example, the projection of a gold bull market in the future.
I do look at price projections, although I don't look at other people's price projections. And I understand that projections are just that. If I believe that the set of circumstances exists that should take prices higher, I obviously do factor that in. When I'm constructing a back of the envelope market around a company, as an example, in the gold price, I may do a $1,500 case. Then I may do a current case, an $1,800 case, and I may do a $2,500 case. And I consider the probabilities around each. My favorite circumstances, of course, are commodities where they're priced on world markets less than the median cost of production worldwide. As an example, currently in the uranium market, the stuff is selling for $48 a pound, and the industry's average total cost of production, including cost of capital, averages about 60. Either the price of uranium goes up or 5 or 6 years from now, the lights go out. In those circumstances, I try to use industry average incentive costs and do a 3 to 5 year out model using those costs. It isn't to say that I don't use a lower case and a higher case too. I create a matrix. But the truth is that my favorite commodity speculations are ones that are deeply out of favor as a consequence of the fact that the commodity price is unrealistically low.
Thank you so much for that. Sticking on that commodities topic, what are your top 3 sectors for the next 3 months or so?
For 3 months, that's too short a time for me to comment. I'm not a trader. It usually requires 2 to 5 years for commodity markets to play themselves out. I would say for most investors right now, the place to be is gold. I think that the winds are truly in gold sales, and nobody right now cares, but I suspect that everybody will care in the 12 to 18 month time frame. So I would suggest gold. For people who are precious metals investors and more speculative, my experience has been that gold outperforms silver in the early part of a rally, but in the latter part of a rally, the silver stocks move further and faster. So if you can stomach volatility and you're prepared to wait, silver probably has more upside. I continue to be attracted to uranium, although the junior uranium stocks are trading more on narrative than reality. I think buying uranium through, as an example, the Sprott Physical Uranium Trust in the Toronto Stock Exchange is almost a no-brainer over the next 5 years. And for North American investors, buying high quality, free cash flowing oil and gas companies, although the easy money has been made in oil and gas, I suspect on a net present value basis, the high quality companies are trading, discounting $70 US oil and more importantly, $4 US gas in a circumstance where both the oil and the gas prices, both the quotes are substantially higher, particularly for income investors. The high quality listed North American oil and gas companies are generating enough free cash now to at least sustain their current production while at the same time returning a substantial amount of capital to shareholders by way of dividends and stock buybacks.